So welcome back, everyone. Our second paper for today is a paper called Informed Traders and Dealers in the FX Forward Market. It's written by Pierre-Colin Dufresne, Peter Hoffmann and Sebastian Vogel. Pierre and Sebastian are at EPFL and the Swiss Finance Institute, and Peter Hoffmann is at the European Central Bank. Our presenter is Sebastian, who's raring to go. He's a PhD student and is working on electronic OTC markets. So over to you, Sebastian.
All right. Yeah. Good morning, everybody, or good afternoon, depending on where you are. Yeah. Thank you very much to the organizers for accepting this paper and including it on the program. Yeah, this is joint work with my advisor at EPFL. So actually, just this month, I changed affiliation. So I'm now at Erasmus University in Rotterdam. And yeah, this is and this is also joint work with Peter Hoffmann at the ECB. So before going into the paper, quick institutional backdrop about the FX forward market. The FX forward market is a huge market. So taking numbers from an ECB paper that used data from 2015, they estimate the FX forward market to be 40 trillion euros notional market in terms of notional value outstanding. This compares to 8 trillion notional for the CDS market. And if we do another comparison, the European equity markets, so the World Bank estimates the German French stocks to be having a market valuation of roughly 2 trillion euros. So huge market. Still, it's traded in an over-the-counter market, dealer intermediated, and that may be puzzling to many people because from an intuitive standpoint, an exchange market may be the most efficient market, especially if you have such a large volume market. It should make all the sense in the world to put it on an exchange. If not that market, then what kind of market? So there are, in fact, a couple of theoretical arguments why you should have over-the-counter markets, even maybe in large markets. So some papers made the claim that intermediation chains that you have in over-the-counter markets. So the fact that first a seller may trade with a dealer, the dealer trades with another dealer, and finally the asset arrives at the buyer. Yeah. So these chains may alleviate adverse selection. Also, you usually don't have anonymity in these markets. When you trade with a dealer, that dealer knows your identity. So dealers can at least always make a market for uninformed traders if they don't want to incur adverse selection. These are the most prevalent theoretical arguments why we observe over-the-counter markets and that over-the-counter markets may be better than exchange markets. The questions we asked in this paper are, first, is there actually informed trading in the FX forward market? If there's no informed trading, well, then over-the-counter markets don't have a problem to solve there because we don't have adverse selection. Then if we have informed trading, do dealers, in fact, price differentiate? Do they charge different markups to informed traders and to uninformed traders? Then can we characterize those traders a bit more? Who are those informed traders and informed dealers? And lastly, what are the network implications of being informed? Who are the informed traders trading with, and who are the informed dealers interacting with? So these are our main results. So first, we look at data on Euro USD FX forwards that are traded in the European Union. We use a regulatory data set that we can access at the ECB. And we can actually see all the individual traders' identities and also the identities of the dealers. In that respect, this data set is very unique. And we can not only study markups at a point in time, but we can study how traders over time and the whole network, the whole market. So the results are as follows. First, we indeed find evidence for informed trading. We find evidence that some traders always trade in the right direction. and that if they do it in one period, they also do it in the next. So it's persistent. Then we can say more. We can say something about trading horizon. Some traders, they have persistent skill over short horizons, the very active ones, and some traders have persistent skill over longer horizons, the not so active ones. And we indeed find that informed traders have to pay higher markups. So dealers seem to know who is informed, and they charge them different prices, and they seem to be dealing with this adverse selection problem. They indeed want to be compensated for the adverse selection they're facing when interacting with informed traders. And when we try to characterize those traders, we see that informed traders and also the informed dealers seem to have fewer counterparties. So we think this is an interesting point because first, there are some theoretical arguments why maybe this should be the other way around, but those arguments usually use anonymity. So in a market that's not anonymous, we argue as an informed trader, you want to keep your information secret. You want to minimize information leakage. And if you're really, really informed, then you want to contact as few dealers as possible so that not everybody knows what you're doing and you can actually benefit from your information. And when it comes to the network structure, we see that informed traders seem to be trading with informed dealers. So this is interesting because it relates to the theoretical arguments that I mentioned on the previous slide. So some theoretical arguments assumed that there would be these intermediation chains where informed counterparties would trade with similarly informed counterparties, but this was just an assumption. So we indeed find that this is the case, and we even present a little model where this should arrive in equilibrium. And now the literature. So this paper is related to several strands of literature. First, we have a literature on trading costs in OTC markets. And there you have literature based on search frictions and based on async information. So both of these frictions cause trading costs, and we contribute to this strand of literature because, well, we think our data set is much more detailed, so we can control for many more factors when we actually look at what causes these costs. Then we have the strand of literature on information leakage and dealer informedness. So dealers can learn a lot of things when they look at the order flow. So there are other papers who looked at that, how much you can learn from what is going on certain trading venues, and also that dealers may get informed based on their customers' order flow, a theoretical paper here by Li and Song. So we contribute to that because, well, we have an empirical paper on this dealer informedness and confirm that this is actually the case, that dealers can learn something from the order flow and use that information and their interaction with clients. Then we have the literature on determinants of foreign exchange rate price movements. And first, we have this literature that says order flow can explain those movements. And we contribute and extend this strand of literature by doing this analysis on the individual dealer level. We show that individual dealers can use their client order flow to predict price movements, and they seem to be using that information in the interaction with clients. Then we have the strand of literature on network structure of OTC markets. So who are the informed traders? Who are they trading with? I already mentioned that there are some papers making the case that the more central market participants seem to be more informed, but we actually find that the market participants with fewer counterparties are more informed. And we argue that, well, this is the case because the OTC market is not anonymous. You can see the identity of who you're interacting with, and that's why we get this finding. And there are some papers who make the point that dealers may specialize. So we have papers on the specialization when it comes to trading frequency, when it comes to demand for intermediacy, and we present evidence that dealers may specialize when it comes to how informed you are and how informed your clients are. And finally, the last strand of literature where we contribute to is the literature on why we have OTC markets in the first place. So I already mentioned the theoretical arguments that OTC markets may alleviate frictions with respect to adverse selection. And we pretty much confirm the foundations of these arguments that there are these intermediation chains where informed market participants trade with similarly informed market participants. All right, so the data that we're using. We use, the main data set is the European Market Infrastructure Regulation data. So similar to the Dodd-Frank Act in the US, the European Market Infrastructure Regulation aims at promoting more transparency. Every derivative transaction, so foreign exchange forwards, commodity futures, commodity forwards, derivatives, and various swaps have to be reported to trade repositories. So there are several trade repositories that collect data. And at the European Central Bank, we can access the data from all these trade repositories. And again, a unique feature is that while we observe the identities, we can study every single market participant across time for, over a long period. And in particular, we use the period from May 2018 to 2019. And we did the analysis for the Euro USD forwards, just to have some restriction because the data set is very large. Now, the other data that we're using is the Thomson Reuters tick history data. So there we get streaming quotes that we can use to compare, to have some comparison for the transaction data that we have in the EMEA data set. And we also have the Orbis data set at the ECB, where we can assign types to the market participants, whether they're financial, non-financial, and so on, and also can assign each legal identity to the correct holding company, so that we don't have a couple of hundreds identities for the big dealers, but only the dealer as the identity, like JP Morgan, Goldman, and so on, these dealers active in the market. This is how the data looks like. So here we have on the left, in the leftmost column, the trader type that we get from the Orbis data set. So most traders are either funds, not classified, or non-financial firms. We already can see some differences based on these summary statistics of different trader types. So if we think that funds are the most sophisticated here among all these trader types and informed traders, we can already guess that, well, maybe the informed traders have fewer counterparties than slightly less informed traders. They also have different trade sizes. So they maybe have smaller trade sizes, fewer counterparties. Well, they seem to trade more often, but each trade is smaller. Okay, but well, these were only summary statistics. So maybe you disagree with the argument that, well, funds are more sophisticated. So we want to be a bit more sophisticated and do it a little bit more detailed. So in order to do that, we need the benchmark price in order to study then the price impact and see how informed the market participants actually are. And we also want to study the markup because we want to see if dealers price differentiate and charge different prices to informed and uninformed market participants. And here's how we calculate those two variables. So first we need the benchmark price. So the benchmark price is in both of those things. The benchmark price is calculated from the Thomson Reuters tick history database, where we get several streaming quotes for various tenors from overnight to 1 year. So we take the best bid and ask quotes in each second, calculate the midpoint, and then for each tenor. And then if we have a contract in the EMEA data set, for instance, with maturity of 9 days, then we linearly interpolate the prices for 1 week and 2 weeks. All right. Now, this is the benchmark price for each contract, which is the fair price. With that benchmark price, we can calculate the markup. So from the EMEA data set, we get the transaction price of each contract. When a customer bought from a dealer, what was the price? And we take the difference between that price and the benchmark price to get the markup. So for buys, it's transaction price minus the benchmark price. For sells, it's the benchmark price minus the transaction price. These are the markups. So what you pay in excess of the fair price, the benchmark price. Now, when it comes to being informed, we want to calculate the price impact. And when I say price impact, I mean what in market microstructure we usually call permanent price impact. So the price impact that already got rid of all the temporary price movements due to fees and so on. So here in the price impact, there's no markup, there's no fee. The fee here is the markup, and the price impact is what you permanently have on the market. And we think of it as the change in the fair value after you traded. If you bought and the price goes up, then the next minute on average or the next day, you had a positive permanent price impact. And we do this analysis for various horizons. In the main paper, we do it only for 1 minute and 1 day, and the results are similar if you change those horizons a bit. So they're, yeah. So the interpretation is the fair price of the change in the fair price of the price impact. And when we want to study how what kind of price impact different market participants have and whether this is persistence or not, it's a bit tricky because this price impact is very noisy. So we think of the price impact that the market participant I has at time t as being driven by some persistent skill, mu I, that's fixed for all time periods, and some noise component that depends also on the time. So when we sort traders based on price impact alone, then we sort them to a huge part on this noise, on this error term. So in order to get rid of this error term, we sort them into groups based on a criterion that's correlated with the skill component. In the paper, we use the number of trades that they're doing. And we sort them into groups such that each group has an equal number of trades in them. So that we have a similar variance of this error term, hopefully, in each group. All right, so this is what we're doing. And here are our results.
Can I just momentarily interrupt you, Sebastian, with just a question, clarification question? You've talked about informed traders. Can you define for us what an informed trader is in the context of the
so sorry if I wasn't clear about that. Sorry if I wasn't clear about it. So informed, we think of an informed trader that has a positive price impact and a persistent positive price impact. So if we always trade in the right direction, so if I'm buying and the price goes up, so then I have a positive price impact. And if that happens on average every time I buy, then we say, okay, that trader is informed. That's our definition of informedness. So we have the definition for 1 day and 1 minute in the main paper. We have 2 horizons, one short horizon, 1 longer horizon, and that's our definition of informedness. I hope that's clear now.
That's perfect. Thank you.
Okay, so on the next slide, I want to present you the results, how persistent this price impact is on average. So we grouped the traders into groups based on the number of trades each trader is doing. And we plot the price impact a trader has in the first half of the sample against the price impact the trader has in the second period of this second half of the sample. One is plotted on the x-axis, one is plotted on the y-axis. And well, of course, there's some noise, but the coefficient is significantly positive. So if a trader has a positive price impact in one part of the sample, the price impact is also tends to be positive in the second part of the sample. So there's significance. It's statistically significant. It's both there on the 1 minute horizon and on the 1 day horizon. So a trader that has a positive permanent price impact over 1 minute tends to have a positive price impact in the second part of the sample over 1 minute, and the same is true for 1 day. If I have a positive price impact for 1 day in the first part of the sample, I have a positive price impact in the second part of the sample for 1 day. And actually for one day, it's even a bit better. So the R squared is a little bit higher even for one day. Now, this analysis put all kinds of traders into one pot. So now we do the analysis for very active traders who have more than 10 trades per day and the other not so active traders. And we again look at the 1 minute price impact. And we can see that actually it's only the very active traders who have a very persistent 1 minute price impact. So the very active traders, they seem to have a shorter trading horizon. They seem to care about how the price develops in the very short term, like 1 minute. And for one day, it's actually flat. So the very active traders, we think of this result as that they just maybe don't care about how the price develops over one day, because their trading horizon is so short that it's just random what happens over one day. So no significance whatsoever for the 1 day price impact, but the slope is again significantly positive for the 1 minute price impact. So persistent for 1 minute, but no persistence for 1 day among the very active. Sorry, for the not so active traders here on these slides for 1 minute. And so I already anticipated what I want to say on the next slide, that the very active traders don't seem to care for the price impact on 1 minute, which is shown here for 1 day. If we compare what the 1 minute price impact across active traders and not so active traders and the 1 day price impact for active traders and not so active traders, we see the exact opposite picture. So for the 1 day price impact, it's the not so active traders that have persistent price impact. And the very active traders that have a not so persistent price impact for 1 day, which we again interpret as the trading horizon that different market participants have. The traders who trade very often, they seem to care more about what's happening in the very short term, like 1 minute, and the not so active ones, they really care about longer horizons where they are persistent. Now, characterizing them, we do the following. So we look at, so first we divide the sample into the very active ones, the HFT ones, and the not so active ones. And we look at each of them separately because they sometimes do behave differently. And then we look at the ones that really trade persistently in the right direction. So the 3 groups that had the highest second period price impact in the picture that I showed you earlier. And then we looked at the NACPI group, which are all the traders who had, on average, a negative price impact in both periods. So we think of the NACPI ones as the uninformed ones and the high PI ones as the informed ones. And we see that the uninformed ones in both groups have a higher notional per trade. The counterparties, the number of counterparties is higher for both not so active ones and active ones. And well, the number of trades behaves differently across groups. But here again, interesting finding is the number of counterparties. The informed ones have fewer counterparties, which we explain by information leakage concerns. Then, what about dealers? Are dealers informed? So when it comes to dealer informedness, we cannot look at the price impact because the price impact, well, that's driven by the customers. So here we look at how well the dealers can use their order flow to predict price movements of the exchange rate. So Evans and Lyons already showed that, well, order flow predicts very well price movements. So they look at interdealer order flow. We say, well, interdealer order flow is likely generated by client order flow. If there's a huge order flow from clients, the dealer needs to offset it in the interdealer market. So we look at how well dealers can forecast price movements by looking at their client order flow. And well, on average, the Sharpe ratios, first the R square, is around 2% in this regression. Well, 2% may not seem very high, but we're talking about daily returns here. So the Sharpe ratios are quite significant if you would actually trade on that information. Now, to be fair, a lot of these high R squareds or Sharpe ratios are driven by outliers who do not trade very often. So on the analysis, now we focus on dealers who have a R² below 2% and have a sufficiently high trading volume. So in particular, who have trading volume in excess of 0.0% of the overall market in that sample period. Now, among those dealers, we put the dealers into two groups. One who have an R² above the median, and the other group below the median. So the ones we call informed, who have an R² above the median, and the other ones we call uninformed. And when we characterize them, first we look at the labels. Are they a so-called G16 dealer? And we can actually see that, well, G16 dealers are more likely to be uninformed here, looking at the data. Well, of course, if you only look at the above 2.5% trading volume, then all the dealers are G16 dealers. But among the smaller ones, you have more G16 dealers among the uninformed dealers. Then the notional volume per trade is higher for the uninformed dealers slightly. And the number of counterparties is also higher for the uninformed dealers. So that's similar to the analysis we did for the traders, where the informed dealers had fewer counterparties, informed traders, and here also the informed dealers had fewer counterparties. Now, what about markups? So I already mentioned that informed traders have to pay higher markups intuitively to compensate the dealer for the adverse selection problem. But we can also see that if I have a particularly good trade, if my realized price impact is very high, I also have to pay a higher markup. So we just explain that the dealer knows something about how the price will develop. So the dealer gets some order flow, has some idea where the price might be going, and adjusts this markup depending on where the price is actually going. And what confirms this hypothesis is that this effect is stronger for the informed dealers. So for all dealers, it's true that, well, if the realized one-day price impact or 1 minute price impact is high, I have to pay a higher markup. But if I'm on top of that trading with an informed dealer, so one with an R² in the exchange rate order flow regression above the median, well, this adjustment is even larger. So dealers seem to actually be learning and from client order flow, and they seem to be using this information when interacting with clients. Then lastly, what about the network structure? Now, here we just do a linear probability model, so just a regression on whether you're trading with an informed dealer or not. And we have several explanatory variables. So in the first regression, just the average one-day price impact, which is our proxy for being informed or not, or actually our definition of being informed, that I'm on average trading in the right direction. And if I'm doing that, then the probability that I'm trading with an informed dealer is much higher than if I wouldn't be informed. So how large my average one-day price impact is determines the probability, or increases the probability of trading with an informed dealer. Now, admittedly, this regression is features some circularity, this argument, because first we defined dealer informedness as the informedness of the order flow of the dealer. So it's kind of mechanical that if I look at who is trading with informed dealers, it's the informed clients. But we also do an analysis where we get rid of the circularity problem. So we first define dealer informedness using one half of the sample, and then look at where the other half of the sample is trading it. So we have completely independent definitions of dealer informedness, and then the informedness of the traders that we are analyzing. And we get similar results. We get that the informed traders in the second part of the sample trade with the informed dealers, where we determine dealer informedness using the other half of the sample. And we actually have a model to explain that. So we argue that if there's an informed trader that wants to trade that trader sometimes just cannot get a quote from the uninformed dealer because there's a strong adverse selection problem. If there's strong adverse selection, no matter what the dealer does, the dealer will lose on the trade. Only if the dealer goes to an informed dealer that adverse selection problem is alleviated and there can be trading being done and the private benefits can be realized in that trade. So this is the model. So I actually only put the slides there in case there are questions. I didn't intend to talk about this. So instead, let me, since I'm anyway close to the 30 minutes, let me just wrap up. So how does informedness matter? So we wrote a paper on informed traders and dealers, who they are and how they interact with, who they interact with. So first, if I'm informed, you get price differentiated, you get charged a higher markup, so dealers can get compensated for this adverse selection problem. The more informed dealers also better adapt to these market conditions. When the price goes up and there's somebody wants to buy, well, the markup goes up if you trade with an informed dealer. So they seem to be using the information that they can generate from client order flow. And we can also say something about the network structure, that informed traders can trade with informed dealers. And this is particularly interesting if you look at the big picture, why we have over-the-counter markets in the first place. The theoretical arguments were assuming that you have intermediation chains where informed market participants trade with similarly informed market participants. And we justify this assumption in that we indeed find this kind of behavior in actual markets. So this seems to be confirming that over-the-counter markets have some benefit or may have some benefits. And one policy implication would be that, well, one should be a bit cautious when trying to centralize OTC markets because they may have some benefits compared to exchange markets. All right, so I'm done with the presentation.
Excellent, thank you very much, Sebastian. Before we move to our discussion, just a reminder that you should send through questions on the web chat, and hopefully you can see the web chat on your screen. If not, I was going to say call out, but I guess you can't call out because you can't use the web chat. But without further ado, I'll introduce our discussant, who's Richard Payne. Richard is a professor at the CAS Business School. Richard works across a range of different areas in microstructure, but is best known for his work in FX markets. So looking forward to his comments on this paper. Over to you, Richard, and you can go ahead and share your screen.
Thanks, Carol. Okay, I hope you can see those slides. So thank you very much to the organisers for giving me the opportunity to discuss this paper. I very much enjoyed it, as you might expect. Let me just start by giving you some highlights of what happens in the paper, and then I'll proceed by and large, giving the authors some comments on where they might apply some polish and suggestions on how they might extend their work. As Carol said, much of my early research was in spot FX markets. So one of the things I'm unsurprisingly going to do is to encourage the authors to delve more deeply into the spot FX literature to find some parallels with what they do. So what happens in this paper? So the authors use a year of data on euro-dollar forwards, which they've got from the ECB. And the great thing about these data is that they identify counterparties. And on the basis of those data, so those are trade data, on the basis of those data, they use the counterparty information, they divide traders into various different types, and they do analysis of how trades relate to price impacts, often at the grouped level, so at the type level rather than at the individual trader level. In order to do that analysis, they need data which is other than just the transaction prices. So they match their trade data with Reuters data. I shouldn't call it Reuters data, but yeah, sorry, Reuters data on Thomson Reuters data on spot FX rates and FX premia in order to give benchmark forward rates. And they're going to use those benchmark forward rates to compute both markups on trades and the price impacts of trades. And those price impacts, and those are percentage changes in benchmark prices subsequent to individual trades, those price impacts on trades are going to be used to classify individual customers into informed and less well-informed people. So the empirical focus is on the information content of customer order flows. As I say, we're going to take customers, we're going to take the trades that they do, we're going to measure the average price impacts of those trades, and therefore we're going to classify customers as being more or less informed. We're then going to, the authors are then going to look at how information received by dealers from customers is used. So if I'm a dealer, do I end up trading with a large number of informed customers? If so, my order flow, my aggregate order flow as a dealer is informed. And the authors are going to go on to ask, how do the dealers exploit or utilize that information? And subsequent to this empirical work, there is a theoretical model. Now, Sebastian spent one slide talking about the theoretical model, and I'm hoping that he wasn't expecting me to talk at length about the theory, because I've dealt with the theory through that single bullet point on this slide that says supported by a theoretical model. The subsequent comments I'm going to give are entirely about the empirical work. So what the authors do is they take these data, they classify trades and traders, customers, clients, whatever you want to call them, according to how informed they are versus their price impacts, and then they analyze the effects of the constellation of your customer base as a dealer on how you behave. What are the key empirical findings? Well, there's key heterogeneity in price impacts across customers. So some customers are more smart and some customers are less smart. And importantly, there's persistence in this across time. So folk who were smart or had large price impact in the first half of the sample also tend to display the same characteristics in the second half of the sample. I guess we shouldn't be too surprised about the first half of that claim, that there's heterogeneity in price impacts across customers. The fact that there's persistence in price impacts across the two half of the samples within customers is supportive of the fact that there are some smart people and their intelligence doesn't degrade very quickly. What the authors also show is that aggregate client order flow observed by dealers has the power to forecast returns. And again, there is heterogeneity. So my ability as a dealer to use my order flow to forecast subsequent returns on forwards is, well, that depends on precisely who makes up my client base. And dealers who receive the most informative client order flow exploit it by charging greater markups to those to trades from better informed customers. And the final bullet that I've got here, which has some nuance to it, and we'll come back to that later on, is that informed customers are more likely to end up trading with informed dealers. So you could argue that that might be natural if uninformed dealers shy away from trading with informed customers. But there's, as Sebastian alluded to, a little bit of circularity in the definitions here. So general comments, it's a great paper and the data is absolutely incredible. I would say that there are some very clear ties that can be developed to work in spot FX markets that would allow the authors both to sharpen and refine what they're saying and how it relates to what's gone before. I would also say that the research agenda and the empirical work might be a little more sharp. They might ask slightly more focused questions. I'll come on to this in a second, which get to the why of what's going on rather than the what is going on. And on the basis of that, I think, with a little bit more work here, the paper has the potential to really break some new ground. So I'm just going to spend a couple of minutes placing this paper in the spot FX literature. The great thing about the data that these authors use is that they have a multitude of clients trading with a multitude of dealers, and they can characterize all of those folk. Most of the papers in the spot FX literature don't have both sides of that. They either have one dealer and many clients, or many dealers and no clients. So it's worth bearing that in mind. However, there are some results that kind of parallel what the authors are saying in this paper that exist out there in the spot FX world. So there's this paper by, for some reason I've written Sarno et al, but it's actually Menkoff et al. And I apologize if Lucas is on this call. This paper by by Menkoff et al. 2016, which focuses on a single dealer with many clients. That paper establishes very clearly in a spot FX setting that the information content of trades differs with well-defined customer types. So they look at financial customers, they look at real money customers, and they demonstrate very clear differences and persistent differences in price impacts between those folk. They go on to ask and to investigate why the trades of different types of customers move prices or not. So they move on from the, are price impacts different question to the why are they different question. There's a nice paper by Guy Biones, Carol Osler, and Dagfinn Riem in 2009. Again, it's in a dealer-to-dealer setting. They demonstrate that price impacts vary across counterparties. Again, they have one particular Scandinavian bank, and they have all dealer counterparties in that bank, of that bank. So this is focused on the dealer-to-dealer market. And they demonstrate also that there are very clear heterogeneities in price impacts across those client types. And tooting my own horn for 10 seconds, I've got a paper with Michael Moore, again a dealer-to-dealer paper, where we identify clear variations in the information content of trading by client, depending on things like the size of the institution, the size of the trading floor, and things like that. And we also investigate why certain clients tend to be good at, why the flows of certain clients tend to forecast returns. And we kind of ask whether smart traders' order flows forecast the future flows of others. Also in the spot FX side, on the theory, there's lots of work based on the original Lyons paper, the Evans-Lyons theoretical setting, which I think might be brought into this paper a little bit more meaningfully. For example, there's a nice two-tier paper by William Peridin and Paolo Vitale in the late 90s. So I guess what I'm saying here is that there are papers out there in the spot FX literature that very clearly relate to what these authors are doing. They don't overlap wholly with what these authors are doing at all. I mean, as I said right at the beginning, the data that these authors have access to contains many clients and many dealers, and the majority of the spot FX papers simply do not have that clarity. And so the paper that I'm currently discussing can credibly claim to have a much more refined view of how the world is working than these papers, although these papers do answer some of the sub-questions that Sebastian and his co-authors are answering, albeit in the spot FX market. Some comments on and suggestions on what Sebastian and his co-authors do. And as I said, I'm going to focus on the empirical work because I'm a person who likes data rather than theory. We're measuring how informed folk are by looking at realized or average price impacts. And some context on the magnitude of those numbers would be useful to me at least. So for example, how do they compare to those in spot FX markets? And what does that tell me about information flows in this market relative to the spot FX market? Information flows specifically through trading. So I'd like some context there. I'm also keen to see, given the depth of the data that the authors have, I would also be keen to see analysis of some slightly more deep questions. I mean, the authors discuss the possibilities of why traders in FX markets might be informed. And they tell a couple of stories. And that's one of them is that smart traders have flow that forecasts future aggregate flow. And another story is that smart people understand macro news more quickly than dumb people do. And I wonder if the authors can use their data and its breadth and its time series length to actually investigate those stories. It certainly seems that you have the data and the means to attack the first story very, very sharply. And discriminating between these sources of asymmetric information that underlie the results that you're getting, I guess it would add real value to your paper, and it would also inform your theory. And when studying, again, this is going back to the spot literature to an extent, when studying the forecasting power of dealer level flows, I'm interested as a benchmark in the forecasting power of the aggregate flow received by all dealers. So if you just sum the flows that all dealers receive, does that thing allow you to make a load of money? I mean, it's not as if anyone sees it, but I'm curious what that thing looks like as a benchmark. The analysis relating to dealer markups and dealer choice, the presentation in the paper is somewhat confusing to me. And I concede that every situation of confusion, it may be the fault of the confusee or the confuser, and I concede that the confusee, i.e. me, may be at fault here. But I'm unclear about the construction and also importantly, the timing of some of the variables in these regressions when you're relating markups to the characteristics of clients or the information content of the trading of clients. So it's not entirely clear to me how realized price impacts are defined. And that matters for the interpretation of your regression results. I presume they're daily. I presume they're contemporaneous with the markup variable. But again, I think I need to know more clearly before I can think hard about what your regressions are telling me. As Sebastian conceded in some of these regressions, the definition of an informed dealer relies on that person having informed customers. So when the authors are making claims about the probability of informed customers trading with informed dealers, well, informed dealers are only informed because they have informed customers. So there's an issue there that the authors are aware of, and they try and solve it by partitioning the data. But when they partition the data, there are rather large changes in the results for certain subclasses of traders, which deserve some discussion. Some other small things. The HFTs in our data trade 10 times a day. I don't know enough about the forward foreign exchange market to say whether that's lots or little, but it doesn't seem a lot from the context of other HFTs I'm aware of. And then I have a few issues or questions regarding clarity and comparison of some of the figures across figures. I won't go through those in detail. I'll leave those for discussion with Sebastian later on. But I guess suffice to say, this I suspect is a first draft of a paper. So there are some tables and some figures which I think could be explained a little bit more carefully. And I'm not sure how some of the tables actually hang together. So I guess I should wrap up. There's some excellent work in this paper already, but some sharpening and some extension of the research agenda would strengthen it further, in my view. I am very curious about the source of the information asymmetries that the authors uncover. A little bit more precision in the formation of the paper and describing in particular how data are categorized and how variables are constructed and timed would be really helpful to the reader. And I also think that a very deep connection to the spot FX literature might be very useful, especially the early spot FX literature where we were also talking about OTC markets. So that's me done. Thank you very much. And thanks for the opportunity to read the paper.
Excellent. Thank you very much, Richard. I'm conscious of time. We have about 10 minutes left, and I have a couple of questions from the audience. So I'll go to those first, and then if we have time, I'll come back to Sebastian to get his comments, or otherwise he and Richard can chat after the event. Anyone that's having trouble finding where to give or post your question, click on the details box on the left side of your screen, and that will bring you to the About page, and then click on Questions. So if you have questions but haven't yet been able to figure that out, hopefully that's an assistance. So the first question is from Brian Taylor from BTA Consulting. And he says, a number of multilateral exchanges have introduced FX markets. Have you compared your conclusions with the data from those markets to support your idea that it may be dangerous to centralize the market? Surely a multilateral market will lower dealer costs and make the market more efficient.
Should I reply right now?
Yes, please go ahead.
Okay. Yeah, indeed, there are many electronic platforms now in the FX market. And so my understanding is that pretty much all of the trades are still done bilateral. So yeah, it's true. You can do a request for quote, contact many dealers at once, but then individual dealers reply to you with a quote. So eventually your trade still happens with a single dealer. So in my point of view, that's still in this over-the-counter market setting and not, yeah, okay, when I talk about centralizing OTC markets, I'm really talking about putting it on a central limit order book, where really supply and demand all comes in one place. RFQ platforms and all these electronic trading protocols that we have right now are still not like that, I would say. So that still preserves the bilateral nature of OTC trading, and that still should preserve the ability of dealers to deal with adverse selection. So I think yeah, electronic trading platforms, they make sense. They introduce competition among dealers, and they still preserve dealers' ability to deal with adverse selection. So I think that should be a good thing. Yeah.
Great, thank you. We have a couple of questions from Carol Gress from University Paris Dauphine. Firstly, she asks, how are your findings consistent or inconsistent with the literature showing that informed traders in the OTC markets are the most central in the network?
So there's there are two papers I'm aware of who make that point. And well, yeah, as I mentioned in the earlier, so these arguments that they usually don't have, so they usually have some kind of anonymity. Yeah, so you don't observe your counterparty, and these are the instances where you can hide your order flow somehow by contacting many dealers. We argue that, well, maybe this assumption is not really that justified. So in over-the-counter markets, you can, yeah, observe the identity of your counterparty, and that's the reason why our results may differ. Why actually there may be some information leakage concerns. That if you're informed, you may not. I mean, there are papers also on information leakage, so it's not like we are contradicting like the entire literature. So there are some arguments in favor of that, some arguments in favor of the other claims. So there are some other theoretical arguments that seem to suggest, well, if you're actually informed, you should maybe contact fewer counterparties.
Okay, great.
I hope that answered the question somewhat.
Sure, and Carol has a second question. She says a possible explanation for your results could be that on a forward market, the biggest traders, many counterparties and large trades, trade for hedging motives, not for information, while the informed will trade with less available capital, so smaller traders, less counterparties, smaller trades. Then it could be different on a spot market. Is that a likely explanation?
Yeah, sure. I mean, we don't take a stance on the motive. It's definitely, yeah, I think it definitely explains why some people don't have a price impact, or even seem to have a negative price impact. Whereas we are not sure whether that's driven by noise or whether they indeed have a persistent negative price impact. But hedging demand may certainly explain that they don't trade to make money on that trade, but trade for something else. So absolutely, I think that's not, as far as I understand it, that's not a completely different story, but that's kind of supplements what we're presenting, and yeah, but we don't take a stance on the source of the demand. Yeah.
Okay. Then Marios has a question as well. Type of information of informed dealers versus informed traders that they trade with. Can you say something related to long-term versus short-term information?
Yeah, only what I mentioned in the presentation. So we do our main analysis when it comes to the network structure with the one-day price impact. Yeah, some traders seem to have different trading horizons. Yeah, that's maybe something where we still need to go a bit deeper. So unfortunately, the whole COVID situation that's slowed us down a bit. not possible to access the ECB anymore. But...
No problems. One more question from the audience, from Samapan Norn. He asks for some clarification. Why would an informed trader go to an informed dealer? An uninformed dealer, by definition, may not identify an informed trader, and so informed traders may be better off to trade with an uninformed dealer.
Yeah. Great question. So that's why we have the model in the last part that I unfortunately didn't want to present. So we argue that sometimes there's an adverse selection problem. So if I'm informed, then the dealer that wants to trade with me is usually in a bad position. Yeah, whatever price the dealer quotes me, if I'm willing to trade on that price, the dealer probably loses money, and dealers don't like that. So if a dealer sees an informed trader coming, the dealer may say, well, I'm just not quoting to you. I mean, it's possible since the market is not anonymous. So in our model, we say that, okay, the only dealer where an informed trader can actually obtain a quote and trade with are the informed dealers. So yeah, maybe the informed trader would like to trade with an uninformed dealer, but it's just not possible because the uninformed dealer is not willing to give a quote. Whereas if the informed trader goes to an informed dealer, well, the dealer knows the correct price, and the dealer can provide a quote, and they can trade based on their private valuations, like private motives to trade, hedging motives or something like that.
Okay, terrific. So we have about 3 minutes left. If you wanted to respond to any of Richard's comments or draw out any issues related to that. Did you hear that, Sebastian? Would you like to take a couple of minutes to respond to Richard?
Yeah, maybe very briefly in the time that's left. So yeah, thanks a lot for the nice discussion. And yeah, I mean, great suggestions. So with the literature on the spot markets, I think these are great suggestions. I think I largely agree with you on that they try to ask similar questions, and we think, well, our data set is a little bit better, and maybe we are able to address some questions with better just because the data set is more detailed. And also our main point is to go in a different direction. So then to look at the network structure and so on, what the other papers didn't do, because they usually had like one dealer and counterparties data set, whereas we have actually the whole market, many dealers and all the traders. But yeah, probably we should make the relation to the literature a bit clearer and look at the parallels and similar questions. Then, what can I still address? Yeah, maybe we should talk more, but afterwards. So
okay.
Yeah, just the time is up, right? Or should I just? There was one question about the realized price impact. So yeah, we actually use the contemporaneous price impact. So when the price goes up over the next minute, and we compare it to the markup that's paid right now, and we indeed show that, well, if the price impact the fair price goes up in the next minute, the markup actually adjusts depending on that. So we interpreted this that some dealers have some idea where the price is going and adjust their markup depending on where they think the price is going. Otherwise, on the other things, yeah, it would be great to talk to you more in detail. Yeah, for sure.
Terrific. Thank you very much, Sebastian, for a great presentation, and to Richard for an excellent discussion. Thanks to all the questions. So we're now going to take a bit of a break for about an hour 50, so people can go off and get on with their lives, and then come back and rejoin us at 1 o'clock London time. So hopefully we'll see you all again then. Thank you.